Okay, we're ready to start our session. We'll turn it over to NABE President Manuel Balmaseda.
Hello. I would like to thank, first of all, Governor Brainard for being here with us at the 2021 NABE Policy Conference. Governor Brainard needs no introduction. You all know her very, very well, but I guess I will introduce her anyways. Governor Brainard has served on the Federal Reserve Board of Governors since 2014. Before joining the Fed, her career has expanded from the private sector to academia to public service. She held positions in McKinsey, taught at MIT, and spent time at Brookings. In public service, she served as the United States Undersecretary of Treasury for International Affairs and Deputy Director of the National Economic Council. Quite an impressive track. Governor Brainard has been quite outspoken on a lot of issues, in particular on the expansion of the full employment in the dual mandate of the Fed to include inclusive employment indicators, on the risks posed by climate change on financial firms, and on the optimal regulatory framework of the financial industry to ensure its safety and soundness, especially after the COVID shock, just to name a few. All of these issues, as you all know, are of primary relevance right now at present. Governor Brainard, thank you very much again for sharing this time with us, and the virtual floor is yours.
Well, thank you very much for that very kind introduction. It's now been a year since the onset of COVID in the US, and the year has been marked by heartache and hardship, especially for vulnerable communities, but also by the resilience and extraordinary efforts of so many people, particularly those on the front lines. The past year has also seen determined efforts on the part of policymakers, public health, fiscal and monetary, to do what is necessary and stay the course until we return to full strength. These determined efforts have contributed to a considerably brighter outlook. Even so, the fog of uncertainty associated with the virus has yet to lift completely, and current employment and inflation outcomes remain far from our goals. The focus on achieved outcomes rather than the anticipated outlook is really central to the committee's guidance regarding both asset purchases and the policy rate. The emphasis on outcomes rather than the outlook corresponds to the shift in our monetary policy approach that suggests policy should be patient rather than preemptive at this state of the recovery. So I'm going to just touch briefly on the outcomes that have been achieved, the outlook that is anticipated, and the implications for policy. Recent data indicate that activity has picked up in the United States this year. After a dip in the final months of last year, personal consumption expenditures stepped up considerably so far this year, especially on durable goods. This seems to be consistent with a quick spend out from the CAA stimulus checks at the turn of the year, particularly among lower income households that may have previously exhausted funds from the CARES Act. Like the spending data, the labor market turned more positive in January and February following weakness at the end of last year. But although the unemployment rate has moved down 0.5 percentage point since December, the labor market recovery is K-shaped and very uneven across racial groups, industries, and wage levels. For instance, the employment to population, or EPOP ratio, for Black prime age workers is 7.2 percentage points lower than for white workers, while it is 6.2 percentage points lower for Hispanic workers than for white workers. And that's an increase in both of those gaps of about 3 percentage points from their pre-crisis lows in 2019. Workers in the lowest wage quartile continue to face staggering levels of unemployment of around 22% in February, reflecting the disproportionate concentration of lower wage jobs in the service sectors that have been hardest hit by social distancing. Jobs in the leisure and hospitality sector in particular are still down by roughly 20% relative to pre-COVID levels. So overall, with 9.5 million fewer jobs than pre-COVID levels, we're far from our broad-based and inclusive maximum employment goal. Inflation similarly remains far from the goal of 2% inflation on average over time. Headline and core PCE inflation were about 2% on a 12-month basis throughout 2020 and came in at about 1.5% in January. And finally, while vaccinations are continuing at an accelerating pace, over 2/3 of the adult population still has to receive their first dose, and there are risks for more contagious strains of the virus, social distancing fatigue, and vaccine hesitancy. So having reviewed outcomes so far, let's turn to the outlook. As the economy reopens, the potential release of pent-up demand could drive stronger growth in 2021 than we have seen in decades. But it's uncertain just how much pent-up consumption will be unleashed when social distancing completely lifts. With PCE accounting for roughly 70% of the economy, the uncertainty around consumption spending flows through to uncertainty about activity, employment, and inflation. In part, that outcome is going to hinge on distributive questions that we don't understand clearly. Households accrued considerable additional savings that led to a 2.1 trillion increase in liquid assets by the end of last year. And higher income households appear to have cut back on discretionary services spending and increased their purchases of durable goods, which may see some satiation going forward. For moderate income households that aren't cash constrained, it's possible there'll be a lower near-term spend out from the ARP payments relative to the CAA payments, given that there was less than 75 days that elapsed between them. That said, there is an upside risk if a substantial amount of the stimulus payments and accumulated savings are spent in 2021 rather than more slowly over a longer time period. On the other side, there's some potential for leakage abroad if as anticipated foreign demand growth in some regions is weaker than in the US. Imports soared during the second half of last year and grew further in January, even with worsening backlogs at US ports. As port congestion and supply chain bottlenecks ease, international spillovers could lead to some slippage between the increase in domestic demand on the one hand and resource utilization. That has implications for employment and inflation, so I'll turn to those next. In the labor market, as vaccinations continue and social distancing eases, businesses in those hard-hit services sectors I described earlier will increase hiring, and this will accelerate the pace at which workers find employment. The strong and timely support from fiscal as well as monetary policy likely reduce the extent of scarring during the pandemic, and that should help the pace of hiring at in-person services establishment once the virus is well controlled. The speed of further improvement in the labor market following that initial rush of reopening is less clear. Some employers may be cautious about significantly increasing payrolls before post-COVID consumption patterns are more firmly established. Others may be implementing cost-cutting measures. We saw in the December Duke CFO survey, roughly 1/2 of CFOs from large firms and about 1/3 from small firms reported using or planning to use automation and technology to reduce reliance on labor. In addition to greater use of technology, there's likely a significant amount of slack in the participation and part-time margins. The EPOP ratio among prime age workers is still a full 4 percentage points below its pre-COVID level. And there are about 1.7 million people more than pre-COVID who are working part-time but want full-time jobs. Although core and headline PCE inflation came in at only 1.5% in January, the well-anticipated base effects from price declines in March and April of last year will cause inflation to move above 2% in this April and May. It also seems likely that a surge of demand may be met by some transitory supply bottlenecks, leading PCE inflation to rise somewhat above 2% on a transitory basis by the end of this year. But following those transitory pressures associated with reopening, entrenched inflation dynamics are likely to reassert themselves. Underlying trend inflation has been running persistently below 2% for many years. And research suggests that although diminishing labor market slack may show through to wage inflation, the pass-through to price inflation has become highly attenuated. This could be because businesses tend to respond to increased labor costs by reducing margins rather than increasing prices later in the cycle. In fact, recent decades provide little evidence to suggest there'll be a material nonlinear effect on price inflation as resource utilization continues to tighten. So what does this imply for policy? The FOMC has provided powerful forward guidance that is based on employment and inflation outcomes. This approach implies resolute patience while the gap closes between current conditions and the maximum employment and average inflation outcomes in the guidance. By focusing policy on eliminating shortfalls from maximum employment rather than deviations in either direction, and on the achievement of inflation outcomes that average 2% over time, monetary policy can take a patient approach rather than a preemptive approach. A preemptive approach would have called for a reduction of accommodation when the unemployment rate nears estimates of its neutral rate in anticipation of high inflation, but it risks an unwarranted loss of opportunity for many of the most economically vulnerable workers and entrenching inflation persistently below its 2% target. Instead, the current approach calls for patience, enabling the labor market to continue to improve and inflation expectations to become re-anchored at 2%. One simple way to think about this difference is the way in which market expectations around the conditions associated with the liftoff of the policy rate from the lower bound have shifted in response to FOMC communications about the new policy approach. For instance, in the surveys of primary dealers and market participants conducted by the Federal Reserve Bank of New York, we can compare the most recently available surveys from January 2021 with the surveys in March of 2015 under the previous policy framework. So in the most recently available surveys, the median respondent expected the unemployment rate at the time of liftoff to be below 4%, as compared with 5.3% in the March 2015 surveys. And in the January 2021 surveys, the median respondent expected a 12-month headline PCE inflation rate of about 2.2 to 2.3% at the time of liftoff, as compared to about 0.5% in the March 2015 surveys. The FOMC has stated that in order to anchor inflation expectations at 2%, it seeks to achieve inflation that averages 2% over time. This recognizes that the public's expectations of inflation are linked to their experience of inflation outcomes. And in the 9 years since the committee formally defined price stability as annual PCE inflation of 2%, the average 12-month PCE inflation reading has been actually 1.4%. With inflation expected to rise above 2% on a transitory basis, I'll be closely monitoring a dashboard of indicators to assess inflation expectations remain well anchored at levels consistent with our objective. Survey measures have picked up a little bit, but remain around pre-COVID levels. Meanwhile, 5 and 10-year TIPS-based measures of inflation compensation have moved up almost 1 percentage point since last summer, and are now at levels last seen in 2013 and 2014. These changes likely reflect both the improvement in the macro outlook and market participants' understanding of the committee's new reaction function. The overall price stability objective of achieving inflation that averages 2% over time also provides an important guidepost for assessing the path of inflation ahead. Along with realized inflation, I'll be monitoring a range of inflation concepts to assess the path of policy that would be consistent with closing the inflation gap under a variety of makeup strategies. So in sum, although the outlook has brightened considerably, with jobs nearly 10 million below the pre-COVID level and inflation still persistently below 2%, the inflation and employment outcomes remain far from our goals, and it will take some time to achieve substantial further progress. By taking a patient approach based on outcomes rather than a preemptive approach based on the outlook, policy will be more effective in achieving broad-based and inclusive maximum employment and inflation that averages 2% over time. So with that, I'll turn it back to you.
It's not a conference unless you leave the mute button on. Thank you very much for your remarks. Actually, you opened the room for a lot of questions, a lot of different issues. I'll start with the first thing you mentioned, which is, and we'll talk about policy later. You talked about the K recovery, and we were talking about it earlier, right? It is true that we already were seeing inequality growing in the US pre-pandemic, but the pandemic and the COVID crisis has actually reinforced that trend. The question is, monetary policy is quite a blunt tool. So what can monetary policy do to address the issue?
Yeah, It is the case in the US, and I think this is true also elsewhere, that the COVID crisis has been disproportionately affecting workers and communities that were already economically vulnerable. And we see that in a variety of indicators, whether you look at that statistic I cited earlier, the lowest wage quartile of workers are actually seeing much higher unemployment than other quartiles, above 20%. It's true when you look at sectors, with the in-person services sector seeing much higher layoffs. It's true in the US among racial groups, with the gaps in unemployment moving back much larger than we had seen prior to the crisis. And we've also seen a difference between women and men, with more women reporting staying home, not looking for a job because of increased caregiving responsibilities with school closures in the US. In terms of what monetary policy does, we have seen that in cases where monetary policy is able to focus on the maximum employment leg of its dual mandate, that this brings important gains, particularly to workers that are in lower income categories or traditionally disadvantaged in the labor market, and that those gains are particularly meaningful late in the cycle. In fact, that's one of the observations that motivated our new framework. We have previously had a monetary policy framework that targeted both inflation outcomes, which our new framework does as well, but it also targeted deviations of unemployment from its normal rate. And that has changed. We now are focused only on shortfalls from maximum employment. As I said earlier, that's an important change that will allow the labor market to continue to improve and absorb more workers in the absence of high or unanchored inflation. But I will also say that inequality is a longstanding, complicated problem that has been growing in the United States and will require a much more comprehensive program to address satisfactorily.
Thank you. Now talking about inflation. Inflation is, I would say, finally picking up, right? We had a problem with a few years back that we had too low inflation, right? But still we expect, or analysts expect, all the expectations are for inflation to rise around 2.5% and remain around those levels between 2 and 2.5 for the next couple of years, which seems like the best scenario possible, right? You're stimulating the economy, strongly stimulating the economy, very high growth, and still inflation only goes up to 2.5%. So that's really the best of all worlds. In this world of high growth, ample liquidity, cost pressures, why isn't inflation pressures more acute? And what if inflation stops hibernating? Or putting it the other way around, is given the K recovery and the flat Phillips curve, is the Fed policy more guided towards labor market than to inflation? And you're more willing to let inflation rise even above the 2.5 threshold?
Well, I think, these are questions that we wrestled with a lot and provided very clear guideposts on in the new framework to monetary policy that we announced. And so we take a balanced approach to our maximum employment and average inflation goals. But it is the case that with a shortfalls approach to maximum employment rather than a deviations approach, the labor market can continue to heal, to strengthen longer in the absence of inflation outcomes that would be outside of our framework. In terms of the kinds of inflation path that we are likely to see over the next year and several years, again, I think it's well anticipated that we'll see inflation rising above 2% due to base effects falling out. And also, it's very likely we'll see some bottlenecks if the economy opens up rapidly, and given how much pent-up consumption there's likely to be. But those are likely to be transitory forces, as I noted, and the inflation dynamics that we've been seeing over the past more than decade, are pretty powerful dynamics. And so we would expect to see those entrenched inflationary dynamics really coming back into play. In particular, we know that the Phillips curve, while we see a relationship between resource utilization and wage inflation, we just see a very flat Phillips curve when it comes to the relationship between resource utilization and price inflation. That's been going on for a long time. Underlying trend inflation has been below 2% for a long time. And so those are dynamics that our new framework seeks to address. But in terms of what our framework calls for, it really talks about a moderately above 2% inflation for some time to make up for persistently low inflation. And it talks about anchored inflation expectations at 2%. So for me, those two things are very important guideposts as we assess inflation dynamics. And of course, we have tools, well-established tools, if those kinds of guideposts, if we see inflation that is immoderately and persistently above the goals we set out in our framework.
Great, thanks. And talking a little bit more about inflation, you mentioned at the end what we're seeing is we're still not out of the inflation. Let's say that I don't like calling it this deflation, but this inflationary world in which the pressures down on inflation from global trade, from global factors, bacteria, whatever, are still there. But associated to that, how do you think the COVID crisis has affected productivity, and what is the impact that might have on your outlook?
Yeah, so I think this is one of the big question marks that we hear about from our business contacts. Questions about what's the new normal, questions about whether business models are going to change in some sectors as a result of this period of remote work, whether we might see certain types of continued remote work, perhaps less travel, perhaps more reliance on technology. All of those things, I think, are open questions that we won't have a really full answer to until some time after the economy reopens. It's certainly the case that many businesses have moved to business models that do rely more heavily on technology, don't require as much in-person work. And so the question mark is how much will we see that persisting, and what will that mean for productivity? So it's quite possible we'll see some actual changes there, but I would say I certainly haven't seen analysis which would lead me to be confident that I know what's going to happen.
Thanks. You mentioned bond yields. Bond yields are causing quite a disturbance in the markets, right? Is yield curve targeting needed to reinforce your forward guidance?
Yeah, so we certainly have seen some movements in bond yields as market participants, like all of us, are taking on board new developments with regard to fiscal stimulus, new developments with regard to the pace of rollout of the vaccines, and we'll continue to expect markets to be forward-looking in that way. You know, I would be concerned if I saw disorderly movements. I would be concerned if I saw movements in bond yields that threaten progress on our goals, I would certainly take notice if those movements seem to be inconsistent with our forward guidance in ways that might slow progress towards those goals. So I'm certainly monitoring those developments. But I think our policy framework is well understood. And as I noted earlier, I gave you those examples of the surveys, the market primary dealers and market participant surveys that suggest, in fact, that that forward guidance has really been taken on board.
Great. As you mentioned, as we talked about earlier, inflation seems to be no problem. However, we're seeing quite a high rise of asset price inflation. So the question here also from the table is, what is the right indicator? What is the right measure of inflation that monetary policy should be looking at? Only goods inflation? Shouldn't we be looking at asset price inflation, particularly when we include the perspective of financial stability into the mix?
Yeah, so our monetary policy framework is clear how it defines inflation, and it really is that concept of PCE inflation on a 12-month basis that we look at primarily. Of course, we look at other indicators as well. But separately, we would be concerned, or I would certainly be concerned, if I saw threats to financial stability that could threaten progress on our goals. And so in addition to, but separately from our monetary policy framework, we also have a very clearly elaborated financial stability monitoring framework. And in that framework, one of the key things that we look at is the extent to which we might see asset valuation pressures building or widening out from pockets more broadly in the economy. And certainly, we also look at other issues, funding markets and leverage in and out of the financial sector. But with regard to those asset valuations, certainly, we have seen a number of classes of asset valuations being in the high part of their historical ranges. So, we do see pressures building there. And we are keeping a close eye on those kinds of pressures. We tend to think of macroprudential tools, prudential tools as being more appropriate for dealing with those kinds of vulnerabilities in the financial system. Monetary policy is not a very good tool, and it's already, very focused and appropriately so on its dual mandate objectives.
Great, thanks. A question, when the time comes to actually remove accommodation, will the Fed execute it similarly to the last cycle? I start with rate hikes, then start the balance sheet unwinding after a handful of rate hikes have been executed, or will you attempt quantitative tightening before rate hikes? Tapering can obviously come before rates, but what about the actual unwinding? Another way of phrasing is, at what stage would the Fed start the reduction in the size of the balance sheet?
Yeah, so these are all good questions. They are not questions that are, pertinent, in the kind of coming period. Right now, policy is very focused on providing the requisite amount of accommodation to support the labor market and inflation returning to full strength in accordance with those goals in our guidance. We have been clear about the forward guidance on asset purchases relative to the forward guidance on the policy rate in terms of when tapering might occur based on substantial further progress as compared with liftoff of the policy rate from the lower bound, which has three conditions for it: the elimination of shortfalls from maximum employment, the achievement of sustained 2% inflation, and an expectation that it'll be moderately above 2 for some time. So that sequencing, I think, is well understood. Again, if I look at surveys, market participants, it seems to be well understood there. In terms of further out, we really, that's not an area that has been pertinent to date. But I think we have been clear that we will communicate very transparently and in advance so that the markets understand how we plan to proceed.
Thank you very much. I think we've exhausted pretty much time. We have way too many questions that would take us hours to answer. So let me finish, if you don't mind, with one last question, which is, what are the lessons that we can extract from last year? If we could do things differently, what would we do differently with the benefit of insight? Like there's policy to support Main Street. What would we do?
Yeah, so that is a very, very important question, and I'll certainly be thinking about it for some time. I mean, it is clear that decisive action is absolutely critical in the face of the kind of massive shock that we saw emanating from outside the financial system. We moved quickly, we moved forcefully, we quickly moved in terms of moving the policy rate to the lower bound. We moved quickly to intervene in the short-term funding markets where we saw that massive repositioning and repricing movement. And we quickly put in place, with the support of Treasury and Congress, facilities that were targeted at really shoring up employers of all types in the economy, from small businesses to large businesses to state and local municipalities who are also major employers in the economy. And we think those facilities were exceptionally effective at restoring the kind of credit flows and having private participants come back and provide those flows. So really our interventions turned out not to be very large in many of those markets where we intervened. But I think in terms of the other lessons, it's important for us to recognize there are fragilities in the Treasury markets. And so there's a work program there to try to think about what kinds of changes to market structure, to instruments might be useful there. There are clear fragilities in money markets. And so I think there's an important agenda in terms of money market fund reform, perhaps some reforms thinking about open-ended funds where there might be a mismatch between daily redemptions and the lesser liquidity of some of the holdings. So I think we have a really good set of issues to work on going forward. And, those are a few of the early lessons. I'm sure there will be more.
Thank you very much. As always, it's always a pleasure chatting with you. So I could be here for hours, but a virtual applause and thanks to all of you who sent questions. I'm sorry I couldn't get to all of them. And hopefully we'll see you soon in person at a new conference. Thanks again.
Thank you very much.